I remember watching a trader I knew load up on Tesla in January 2020. He wasn't just in deep, he was all in. Every day, the stock climbed. 10% here, 20% there. By early February, it had doubled in less than 6 weeks. But he'd started reading his brokerage statements like they were a scoreboard of his genius. He ignored every piece of price and volume data that didn't fit his story. When the stock had its first sharp pullback, nearly 20% in just 2 days, he told himself it was just profit-taking. That's when the fear of losing a once-in-a-lifetime gain kicked in. He wanted to sell, but he also wanted to see it keep running. He froze. By the time he acted, Tesla had given back over a third of its recent run. He still made money, but he left a fortune on the table, and that profit felt more like a loss. I've seen this play out in every monster stock cycle. The setup is always thrilling. The run-up feels unstoppable. But the exit, that's where psychology does the most damage. By the end of this talk, you'll know exactly how to spot a true monster stock, ride it with confidence, and, most importantly, sell before the market takes back what it gave you. Because catching a monster stock isn't just about charts or fundamentals. It's about mastering yourself while the market tests you at every stage. My name is Ben, and welcome to ZenStock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. A lot of what I'm about to share comes from a book that's been in my library for years, Monster Stocks: How They Set Up, Run Up, Top, and Make You Money by John Boik. Boik studied decades of market history and broke down exactly how the biggest winning stocks behave, from the first spark to the final blow-off top. And while the market has evolved, the psychology behind these moves hasn't changed one bit. Back in 2013, I caught what I thought was my once-in-a-career trade. It was in Netflix. The stock had been basing for months after a brutal drop in 2011. Earnings came out, subscriber growth was exploding, and the chart lit up like a Christmas tree. I bought the breakout. It ripped higher for weeks, barely giving back a dime on the pullbacks. By the end of the summer, I was sitting on a triple-digit percentage gain. But I started to believe my own hype. I told myself I was in tune with the stock, that I could feel what it would do next. When it hit its first serious pullback to the 50-day moving average, I didn't even flinch. I told myself I was being patient, that I was riding a monster. Then came the October earnings miss. The stock gapped down hard double digits in a single session. I told myself it would bounce back. But that was my ego talking, not the chart. It kept sliding. By the time I sold, I'd given back nearly half my open gains. I still booked a profit, but the experience burned into me. One of the toughest truths in trading. In a monster stock run, the danger isn't just missing the entry, it's holding too long when the signs are screaming at you to act. That lesson reshaped how I trade. It's why I pay more attention to price and volume than to my opinions. And it's why I'm obsessed with the psychology of holding and selling, not just buying. Today, we're going to dissect the full life cycle of a monster stock. From spotting it before the breakout, to holding through the run, to selling before it breaks you. We'll break down the price patterns, the key fundamentals, and, most importantly, the psychological traps that can wreck even the best setups. This isn't just theory. It's drawn from decades of market history and my own hard-earned scars. It's about turning the chaos of a fast-moving stock into a structured plan you can actually follow. And just to be clear, this isn't about chasing hype or betting the farm on a single ticker. It's about knowing how to identify when the odds are finally in your favor, and having the discipline to act and to step aside when the run is over. Monster stocks are like surfing giant waves. They're rare, they're thrilling, and when you catch one, it feels like you're unstoppable. But you need the timing to get in, the balance to ride it, and the courage to jump off before it crashes, because no wave lasts forever. One of the hardest things for new traders to accept is that the best monster stock runs don't start in isolation. They start in the context of a healthy market. John Boik's research in monster stocks showed that nearly every truly explosive move began only after the broader market confirmed a new uptrend, typically between the 4th and 12th day after a correction ended. That confirmation day isn't magic. It's the visible footprint of big institutional money moving back in. Early in my career, I used to ignore this. I'd find what I thought was the perfect setup, strong fundamentals, clean chart, breakout potential, but the overall market was still in a downtrend. I'd buy anyway, telling myself that a great stock can rise against the tide. Sometimes it did, for a few days. Then the weight of the market would pull it right back down, and I'd be left staring at a red position, wondering how such a perfect trade went so wrong. That's impatience talking. That's the fear of missing out. The belief that, if I don't act now, I'll never see another opportunity like this. But when you force yourself to wait for the market's green light, you're stacking probabilities in your favor. You're saying, I only want to play when the wind is at my back and the institutions are buying. And that one shift alone, waiting for confirmation, has saved me from more bad trades than any indicator on my screen. I tell traders this all the time. If you learn to sit through the chop and only step in after confirmation, you'll trade less, lose less, and catch more of the real monster moves. It's not just a chart pattern, it's discipline in action. Every monster stock I've ever studied had one thing in common before it took off: the business was firing on all cylinders. Boik makes this crystal clear in monster stocks. The most explosive moves almost always start with accelerating fundamentals, rising sales, surging earnings, and high returns on equity. It's the fuel that attracts institutional buyers. And when those big funds decide they want in, they don't buy a few thousand shares, they buy millions. That demand is what drives the price skyward for months. I learned this lesson the hard way with a stock back in 2015. It had a gorgeous chart, tight consolidation, high volume spikes on up days. But the fundamentals were flat. Revenue growth was basically zero. I convinced myself the chart says it all and took the trade. It broke out for about a week. Then it rolled over and never came back. That wasn't bad luck, it was missing fuel. A breakout without strong fundamentals is like a rocket without enough thrust. It can't escape gravity for long. Psychologically, chasing a weak fundamental breakout often comes from wanting quick validation. The chart looks ready, so you skip the homework. But when I focus first on fundamentals, I trade with more conviction because I know there's real business momentum behind the price. These days, my filter is simple. If the last 2 to 3 quarters don't show strong and accelerating growth in both revenue and earnings, I don't care how pretty the chart is, it's not going on my buy list. That one rule alone has cut my false breakouts dramatically. When the fundamentals are there and the breakout comes on massive volume, that's when I know the big players are piling in. That's when a chart pattern turns into a potential monster. If you study enough monster stocks, you'll notice something eerie. During their run-ups, they treat the 50-day moving average like a guardrail. They'll come down, tap it, and bounce, but they almost never slice through it on heavy volume until the run is over. Boik points this out in monster stocks as one of the clearest tells of institutional support. Big funds often use the 50-day line to add to positions at slightly lower prices. When they step in, the stock lifts right back up. You can see it in the price and volume like footprints in wet cement. I had to relearn this lesson in 2018 with a stock I'd been riding for months. It pulled back to the 50-day line. Volume was low. Everything about it said normal. But I'd been reading headlines about the sector cooling off, and my fear got the better of me. I sold right at the bounce point. 2 weeks later, the stock was 25% higher without me. The flip side is just as important. When a monster stock does cut below the 50-day on heavy volume, that's not just a dip. That's big money heading for the exits. And when they run, the move down can be as fast and brutal as the run-up was exciting. Psychologically, the 50-day line is where traders reveal their discipline or their attachment. If you can't sell when that line breaks with volume, you're letting ego and sunk costs run the show. If you sell too soon without real evidence, you're letting fear make your decisions. Now, when a stock I own drifts down to the 50-day line, I'm watching volume like a hawk. If it bounces on light volume and then explodes higher on heavy buying, that's a green flag to keep holding. If it slices through with force, I don't argue, I'm gone. The market doesn't reward stubbornness. It rewards alignment with what the big money is doing, and the 50-day line is one of the cleanest ways to see it. The cruelest stage of a monster stock's life is the end. Because at the very top, everything looks perfect. The fundamentals are still glowing. Analysts are tripping over themselves to raise price targets. Your account balance is the highest it's ever been. Boik calls this the Climax run, a furious final surge, often 25 to 50% in just a few weeks. It's intoxicating. You feel like you've cracked the market code. I lived through one of these with Shopify in 2020. It had already tripled from the March lows, then it went vertical. Every dip was bought. Every news headline was bullish. But if you look closely at the chart, the speed of the move was accelerating unnaturally. That's the sign. A monster that's sprinting faster than ever after months of gains is burning through its fuel. The problem is, most traders mistake this for the beginning of another leg up. They start projecting future gains in their heads, and loss aversion takes over. Selling feels like missing out, so they hold, and then watch the stock gap down on heavy volume, wiping out weeks of profits in a single session. When Shopify broke down from that run, it was brutal. I sold into strength near the top because the pattern matched Boik's description to a T. It wasn't easy, my ego wanted more, but I'd rather leave some upside on the table than donate months of work back to the market. Here's the truth, the top never feels like the top. If it did, everyone would sell. That's why you have to learn to spot the signs, parabolic acceleration, heavy volume spikes, and the stock getting way too far above its moving averages. When those conditions line up, you don't wait for confirmation, you act. Because by the time the break is obvious, the easy money is already gone. Monster stocks don't show up every day. In fact, Boik's research shows major market uptrends, the kind that produce them, happen only about a third of the time. The rest? Choppy noise, false rallies, and traps designed to bleed you slowly. Early in my career, I hated the waiting. I'd tell myself, I'm a trader, I need to be in the market. So I'd keep taking positions in mediocre setups, convincing myself they might turn into monsters. They never did. And each small loss chipped away at my capital and my confidence. That's the psychological challenge. Boredom in trading is dangerous. It makes you chase action for the sake of feeling productive. But the market doesn't pay you for activity, it pays you for selectivity. In 2016, I sat almost entirely in cash for 6 months. It felt like an eternity. Friends were texting me about the big movers of the week, and I felt like I was missing the party. But when the market finally confirmed a real uptrend, I was ready. Capital intact, focus sharp. I caught one of the strongest runs of that year because I hadn't been drained by months of fighting bad conditions. Patience isn't passive, it's active discipline. It's scanning, studying, building your watch list, and waiting for the exact conditions that have historically produced the best results. If you can master the months between the monsters, you'll not only protect your capital, you'll protect the emotional resilience you need when the real opportunity finally arrives. Monster stocks are like surfing giant waves. They're rare, they're thrilling. When you catch one, it feels like the ocean itself is carrying you. But here's the thing about waves, they always end. The skill isn't just paddling fast enough to catch one, it's reading the swell before you even jump in. It's keeping your balance when the speed picks up, and it's knowing exactly when to step off before the crash. The traders who master this aren't necessarily the most talented. They're the ones who understand that timing, discipline, and self-control matter more than adrenaline. Because in the market, like in the ocean, the thrill of the ride can blind you to the rocks just below the surface. There's a well-known behavioral finance study by Barber and Odean that tracked over 66,000 US brokerage accounts for 6 years. The takeaway was brutal. The most active traders underperformed the market by more than 6% per year. The cause? Overconfidence, poor timing, and a refusal to sit still between quality setups. It's exactly what Boik warned about, the damage done in the dead zones between major uptrends. You can see the same lessons in the charts of modern leaders. Nvidia, 2023. It wasn't just a hype-driven AI story. Revenue growth exploded triple digits year over year. Earnings smashed expectations, and the stock broke out on record volume just days after the Nasdaq confirmed an uptrend. It respected its 50-day line the entire way up until August. Then came the warning, a heavy volume break through that line. That was the big money heading for the exits. Anyone who ignored it learned quickly how fast a leader can unwind. Tesla, late 2019 to early 2020, deliveries up, margins expanding. It broke out right after a confirmed uptrend and ran over 300%. Then came the exact climax run. Boik described a furious vertical surge, followed by a sharp break through the 50-day on massive volume. Sell into that surge and you bank a career maker. Hold just in case, and you watch a chunk of those gains disappear in days. History doesn't just rhyme with monster stocks, it plays the same song over and over. Different companies, different catalysts. But the combination of fundamentals, technical patterns, and psychological traps stays the same. 1. Overtrading between uptrends. Boik's data makes it clear, major market uptrends only happen about a third of the time. But most traders can't stand the quiet periods. Boredom pushes them into mediocre setups, hoping one will turn into a monster. This isn't just a capital drain, it's an emotional drain. By the time the real opportunity comes, they're worn out and less willing to size up on the trades that matter. 2. Sunk cost fallacy at the top. When a monster stock starts flashing, topping signals, parabolic acceleration, heavy volume spikes, a break of the 50-day, traders often freeze. They tell themselves, "I can't sell now, I've been in since the start," as if holding longer will somehow honor the earlier decision. That's the sunk cost trap, valuing past effort over current reality. In monster stocks, that hesitation can turn a career-making win into just another, almost. 3. Ego over objectivity. The run-up phase of a monster stock can make you feel like you're seeing the market better than anyone else. That's the illusion of control. You start trusting your feelings over the chart. Boik's work and my own scars show how dangerous this is. The market doesn't care how in tune you feel. If the price and volume say the big money is leaving, the trade is over. Avoiding these 3 traps isn't about being perfect. It's about having a framework that forces you to act on evidence instead of emotion, especially when the stakes are highest. Before I buy anything, I run through 3 questions. Has the overall market confirmed an uptrend in the last 4 to 12 days? Does this stock have accelerating revenue and earnings growth over the last 2 to 3 quarters? Is it breaking out of a healthy base on massive volume? If I can't answer yes to all 3, I pass. That one checklist keeps me out of the majority of false starts and into trades where institutions are already showing their hand. During a monster run, the 50-day moving average is my guardrail. If the stock bounces off it on low volume and then rips higher on big volume, I keep holding. If it slices through on heavy volume, I sell immediately. No debate. No, just in case days. This one rule forces me to exit when the big money exits and keeps me from selling too soon just because of a normal pullback. These tools aren't complicated. They're designed to reduce hesitation and remove ego from the process. Because in a monster stock, the edge isn't just in finding it, it's in executing the plan without flinching. Ask yourself this. When was the last time you sat out of the market completely, not because you were scared, but because you were waiting for the perfect setup? Do you have a written checklist that must be met before you enter any trade, or are you still relying on gut feel and a few bullish headlines? When your stock hits the 50-day line, do you know exactly what you'll do before it gets there? Or do you wait until the moment, let your emotions take over, and then hope you'll make the right call? And maybe the toughest one, if you were in a monster stock right now, and it just had a 40% parabolic run in a few weeks, would you have the discipline to sell into strength, even if everyone else was still celebrating? If those questions make you uncomfortable, good. That discomfort is where the growth happens. Because the truth is, most traders fail in monster stocks, not at the entry, but in the patience, discipline, and self-awareness that come after. If you take one thing from this, let it be this. Monster stocks will test every part of you. Your patience while you wait for the right setup. Your discipline while you ride the wave. And your courage when it's time to sell. The patterns haven't changed in decades, but the trader who can follow them with clarity and without ego, that's the trader who turns opportunity into lasting results. So here's your challenge. Write down the biggest lesson you've taken from this talk and post it in the comments. Share this with a friend who's been struggling with holding or selling. And if you found this valuable, like, share and subscribe. It helps us keep creating this kind of content. Master your mind. Master the market. Trade with confidence and live with calm.